Right now, as markets close on March 7, 2026, one of the world's largest chemical producers is making headlines for two very different reasons simultaneously. Dow Inc., listed on the New York Stock Exchange under the ticker Dow, has sealed a landmark long-term distribution agreement with Univar Solutions, one of the world's leading chemical and ingredient distributors. The deal centers on Dow's Decarbia portfolio, a specialized range of low-carbon products designed to measurably reduce the environmental footprint of industrial and consumer supply chains. On paper, it sounds precisely like the sort of forward-thinking move that sustainability-focused investors have been waiting for from a legacy chemicals giant. Yet today, Dow's share price has dropped 8%, as deepening concerns over the polyethylene market threaten to overshadow this green partnership entirely. So what exactly is the Decarbia deal, why does it matter, and what should investors and industry watchers make of this conflicting picture? Let us break it all down, section by section. Before assessing the significance of this partnership, it is worth understanding precisely what the Decarbia portfolio actually is. Decarbia is Dow's branded low-carbon product line, built around reducing greenhouse gas emissions both at the point of chemical production and throughout the downstream supply chain. These are not simply standard chemicals sold with a greener label attached. The Decarbia range incorporates materials produced with measurably lower carbon intensity, achieved through a combination of feedstock switching, manufacturing process efficiency improvements, and in some cases certified renewable energy use at Dow's production facilities. The products span multiple end-use sectors, including flexible packaging, personal care formulation, coatings, and industrial applications. Critically, Dow provides verifiable carbon footprint documentation alongside each Decarbia product, allowing customers, brand owners, formulators, and manufacturers to make quantifiable, defensible sustainability claims about their own goods. In a regulatory climate where the European Union's Green Claims Directive is tightening requirements on environmental marketing, that kind of third-party verifiable data is not a nice-to-have, it is becoming a commercial necessity. So why bring Univar Solutions into the picture? Univar is not a manufacturer, it is a distributor, and a formidably large one. With an extensive global network of distribution centers, technical specialists, and long-standing commercial relationships with thousands of industrial customers, Univar acts as the critical bridge between chemical producers and the companies that actually use those chemicals in finished products. The long-term agreement between Dow and Univar, first detailed by CHE Manager in early June 2026, means that Univar will now carry and actively promote the Decarbia portfolio across its full distribution infrastructure. For Dow, this dramatically extends the market reach of its low-carbon products without requiring Dow to build out a parallel sales and logistics network of its own. For Univar, it adds a differentiated, sustainability-positioned range to its catalog at a moment when customers across every sector face mounting pressure to decarbonize their procurement. It is a commercially symmetrical arrangement. Each party gains something the other cannot easily replicate independently, which is precisely why long-term agreements of this kind tend to stick. One of the most commercially interesting dimensions of this partnership is its targeted application within the beauty and personal care industry. Personal Care Insights reported in early June 2026 that Dow and Univar are actively collaborating to advance low-carbon beauty supply chains, channeling Decarbia products directly into the formulation of cosmetics, skincare, and personal care goods. This is a strategically well-chosen entry point. The beauty sector has faced intense scrutiny in recent years over the environmental impact of synthetic ingredients, petroleum-derived emollients, and high-carbon sourcing practices. Major cosmetics brands are increasingly required, by both consumer expectation and incoming regulation, to demonstrate credible, auditable sustainability credentials across their ingredient supply. Silicones, surfactants, and specialty polymers sourced from Dow are widely used in personal care formulation, making the Decarbia portfolio directly applicable. Interestingly, Univar has simultaneously announced a separate partnership with American Distilling in June 2026 to strengthen its botanical extract range, suggesting the company is assembling a broader, sustainability-oriented personal care ingredient offering across multiple categories at once. Now for the less comfortable dimension of today's story. Despite the genuine strategic logic underpinning the Decarbia partnership, Dow's stock fell by 8% in trading around February 7, 2026, according to Yahoo Finance, and the culprit was not the Decarbia deal. It was the polyethylene market. Polyethylene is one of Dow's most commercially critical product lines. It is the world's most widely produced plastic, deployed in everything from food packaging and agricultural film to industrial containers and medical packaging. When polyethylene pricing weakens or the demand outlook softens, it has a direct and disproportionate impact on Dow's revenues, because plastics and performance materials sit at the heart of the company's earnings. Market participants appear to have concluded, at least for now, that near-term headwinds in polyethylene represent a more pressing financial concern than the longer-term opportunity presented by the Decarbia distribution agreement. This is a familiar pattern in the chemicals sector. Sustainability initiatives generate positive strategic headlines, but short-cycle commodity price dynamics still move the share price in the immediate term. For investors monitoring Dow's position on March 7, 2026, the 8% share price decline raises a practical and pressing question: is this a buying opportunity or a genuine warning signal about Dow's near-term earnings trajectory? The answer depends substantially on how one reads the polyethylene pricing cycle. Polyethylene markets are notoriously cyclical, shaped by global manufacturing activity, oil and gas feedstock costs, and shifts in consumer goods production volumes. If the current softness in polyethylene is a temporary trough, consistent with historical cycle patterns, then Dow's core financial fundamentals may recover as supply and demand rebalance over the coming quarters. Some longer-term investors might consequently view today's pullback as a reasonable entry point, particularly for those who believe in Dow's strategic repositioning around low-carbon products. However, if polyethylene pricing faces a more extended downturn driven by structural overcapacity or a slowdown in global industrial demand, the earnings pressure on Dow could persist well beyond a single quarter. The Decarbia partnership, however strategically sound, is not yet generating revenue volumes sufficient to offset significant weakness in Dow's core plastics division. Looking beyond today's share price movement, the structural trajectory for the Dow Univar Decarbia partnership appears meaningfully positive over a 3 to 5 year horizon. The global chemicals industry faces sustained, intensifying pressure to decarbonize, driven by the EU's Carbon Border Adjustment Mechanism, corporate net zero procurement commitments, and increasingly rigorous supplier sustainability audits from major consumer goods companies. Distribution partnerships of this kind, which embed verified low-carbon products directly into established, high-volume supply chains, are likely to become considerably more prevalent, not less. Univar's scale means the Decarbia portfolio could reach a large and diverse customer base relatively quickly, without Dow needing to establish new commercial relationships from scratch. In the personal care sector specifically, where product margins are higher and brand differentiation around sustainability carries real consumer value, there is demonstrated willingness to pay a measured premium for credibly sourced, low-carbon ingredients. If Dow continues to scale Decarbia production while managing unit costs competitively, this partnership with Univar could develop into a genuinely meaningful revenue contributor within the decade. Here is the clear and considered takeaway as of March 7, 2026. Dow's long-term partnership with Univar Solutions to distribute the Decarbia low-carbon portfolio is a strategically coherent, commercially well-structured move that addresses genuine and growing market demand for sustainable chemicals. The deal meaningfully extends Dow's commercial reach, equips Univar with a differentiated sustainability-driven product range, and targets high-value sectors, most notably beauty and personal care, where verified low-carbon credentials translate directly into commercial advantage for brand owners. The 8% share price decline today reflects short-term market anxiety about polyethylene pricing dynamics, not a broad rejection of Dow's longer-term strategic direction. For those tracking the chemicals sector, this partnership is worth monitoring carefully over the coming months. It represents one of the clearer and more concrete examples of how an established industrial producer is actively repositioning itself for a lower carbon economy, not through abstract pledges, but through tangible distribution agreements with measurable market reach. Whether the market ultimately rewards that repositioning will depend on how effectively Dow manages the near-term commodity cycle without allowing it to erode the strategic foundation it is building.